Before we start, I'd just like to remind you of two things. The first one is the Stockbroker of the Year awards, as you can see on the screen right now. We did really well in this last year, coming second overall and winning a couple of the categories. But most of all, we learn from what it is you guys as our clients value in our offering. So we request that you complete that survey for us. I know it's a bit of a long one, but if you would please complete that survey for us, because it's very, very valuable in us adjusting our service offering to you. Then secondly, you've all seen the disclaimer. I think it's self-explanatory that we try and give you accurate information and try and share with you our views, but it doesn't necessarily represent the views of PSG or not indicative of a suggestion to go out and trade. Guys, we're discussing today, we've got Vaughan in the house. He's back after 2 weeks wandering about, and we've got Ross. Thanks very much for joining us, gents. We're going to be discussing Aspen, who started out in, I think, 1858, they said, in PE as Lennon. We all know Lennon products. Well, I reckon all of us about 40 know Lennon products. And Aspen to this day, specializing in generic or post-patent medicines, being Mybullin, I think Altroxin, and something like Stilpain that we all use. So interesting to hear from you guys, Vaughan, to give us some insights into their numbers. Thank you.
Thanks, Sarel. As usual, we've got our analyst in the house. So Ross van Coller is our analyst on Aspen, so he'll be chatting about it. So over to you, Ross.
Thank you. Okay, well, I'll start with the macro environment as to where Aspen fits into this. Obviously, during the whole COVID pandemic and stuff, they got a nice big contract in 2021, which saw the share price rally quite nicely. But now, as we've seen with Aspen and with even all the global players, Johnson & Johnson and Pfizer, we've seen the COVID vaccine sales come off a cliff, which obviously impacts their revenue. And then we've subsequently seen the share price retract a bit. As we all know, with the healthcare sector, this is a very highly regulated industry. They've been seeing problems in Europe recently and in Australia with the regulators trying to limit the amount that these drugs can be priced at, which we see similar problems here in South Africa. The only tailwind, or the nice tailwind that the pharmaceutical industry can look forward to probably in the next 5 years is big R&D spend, more in 2027, 2028, as a lot of their patents are coming off loss of exclusivity, or they have loss of exclusivity. So as we see research and development go into these drugs, you will see a lot more trials coming out. From a valuation perspective, we don't see much upside in this counter. It's running very much in a tight band, and it's sitting at more or less its 5-year levels, if not slightly above. So we don't see any particular upside in the stock, with a small upside of about 5%. They're about to release their 2023 results next month, but the latest results we have were in December, where they saw quite poor results in terms of revenue declining, their earnings declining. But the main takeaway from the presentation was that they've essentially got more capacity than what the current demand is, and now they've seen an order book fill up with that. So they revised that from 2 billion to 8 billion, stretching out next year and all the way to 2026. But there's not much, they haven't given us too much information about that. All we know is it's 7 different drugs, mainly to do with anemia and blood-related diseases. So we got a hold recommendation, and if they can potentially execute on these additional vaccine output, because management has a bit of a tricky past with the execution risks, and hopefully we can see a re-rating of a multiple to more of their 15-year PEs, which are sitting at about 15. You go to the next one, Vaughan. So just to break down what their revenue actually is, they're focused in 3 areas. Sterile focused brands, which is what I've just discussed. That's the capacity problems they're having. That's your regional brands, which are your over-the-counter consumer goods, like your Mybilin, and then your manufacturing, which is your APIs and your FDFs, which I will get into now. Next one. So this is I've just taken this from the company website, just so you can see what these divisions actually consist of. So the sterile business segment is in anesthetics and thrombosis, which is where they're seeing the new vaccine demand come through. Your regional brands, as I've said, over-the-counter, consumer, branded, and generic products. The only real competitor in this area is Adcock, which is a lot smaller than it. And there you can obviously see Mybilin. And then your manufacturing is obviously just the manufacturing of APIs, which are active pharmaceutical ingredients, and your FDFs, which are your finished dose forms. So it's the actual whole product finished and not just parts of the active ingredients. We go on to the next one, Vaughan. So the last 10-year story on Aspen has been the problem with their debt. They went on an acquisition spree in 2014, 2015, and that saw their debts go to sort of unacceptably high levels. If you look at the graph on the left, net debt to EBITDA, a rule of thumb is about 2.5. Anything above that, you start raising the red flags. But as you can see in the last 3-4 years, they deleveraged quite nicely and brought down that debt to equity ratio to about 35% now. Go to the next one, Vaughan. So yeah, just to have a look at the PE history, if you go back 5 years, as I said, they're trading slightly above that average. In our assumptions, we've got a bull case of slightly above 12. So you can see it is limited there, but it is quite positive that they have deleveraged so nicely and that they not talking about serious acquisitions as they have done in the past. In our markets, the only competitor for them is Adcock, and as I said, that's only in the regional brands segments, and then we have to look overseas for other competitors as Aspen does operate globally. We'll go to the next one. I mean, this is my valuation case. As you can see, I've gone quite narrow as it's traded in some narrow multiples over the last 5-10 years. And we've got a slight upside in 5%. So if you bought this share at the beginning of the year, you would have done quite nicely, up by 35%. But if you look back a bit further than that to pre-COVID years, we've got a 5-year return of 13%, which not ideal. And then, yeah, that's pretty much it from me. I think we go over to the technicals and then on to the questions.
Thank you. Yes, Sean, take it away.
Okay, yeah. So yeah, we can see the chart of Aspen that shows the share prices. I call it testing the resistance zone. It's around the 187 to 189 level. And as Ross says now, the intrinsic value is about 191. Yeah, so they're giving it a hold recommendation. So the share price is trading far above its 21-day and 40-day moving averages, as well as the 200-day moving average, and it confirms a bullish trend. And also having recently just broken up above that, what they call a symmetrical triangle. Saying that the long-term trend, however, is sideways since March 2023. And you can say it's testing at resistance trend line, resistance zone, and the bottom technical indicator, the MACD, it's showing it's also trading in overbought territory and confirms this bullish price action. But other shorter term technical indicators like a RSI stochastic obviously show the share price is pretty overbought at these levels. So we can expect some profit taking soon. If the share price does start pulling back on some profit taking, it should pull back towards those moving averages, which is around the 182 to 180 levels. And also that long-term upwards support trend line. Should that support not hold, we could see the price pulling back to that previous support, that pivot at 175 level. And if that doesn't hold, we could pull right back to 170, 167 level. So, but at this point in time, we still give it a hold. It must still hover around this resistance zone for a while before pulling back. Thank you.
Thank you, Sean. So technically it can pull back to Ross's bear case, which is around 170, 172, if I recall correctly. He is a bit in no man's land testing those resistances at the moment, but an interesting company nonetheless. Ross, when you said in 2027, I think you said there's a lot of patents expiring and that, does it mean that these guys are looking forward to launching new products to which they have access to then?
Yes, correct. So the research and development, these drugs take a long time. They've got to go through multiple, lots of testing, and then they've still got to go through phase 1, 2, and 3 trials with different regulators. But they're just seeing that in those years specifically, a lot of companies are losing a lot of their patents, which means that other companies can start creating biosimilar products or generic products to that. So they want to maintain their edge by getting patents for new products. But yeah, that's what we forecasted to see later this decade.
Thank you. Guys, you're welcome to type your questions in the chat. Otherwise, just raise your hand and ask. I see in the chat there, Thomas has posted the Stockbroker of the Year links and that. So you can just click on those to complete that. Other than that, I don't see any questions here. Vaughan, from a portfolio manager's perspective, pharmaceuticals a must in your portfolio?
Yeah, so as Ross said, he's done some very good work on it. The critical factor with Aspen is that it's gone through. If somebody's on there, if I can just mute. It's gone through sort of a near-death experience where they took on an incredible amount of debt and then they deleveraged. You've got a CEO that's been around for a long period of time and has made acquisitions that we are questioning the long-term returns. But having said that, they have sort of dug themselves out of a bit of a hole. We in our portfolios have life healthcare rather, where there's a far easier upside story with that potential deal where they're going to be buying the one potential component, which in our mind could potentially give you, 30 to 50% upside. So lower risk, better return, and less issues. However, having said that, this one is back on our radar as potentially over time being a little bit more positive. So we're not there yet, but we're thinking about. So we don't have exposure to this one, but we did have a look, hence Ross's work, to see if it's time yet, and we don't think so, not yet.
But in this space, life healthcare definitely a must.
That's the one we have, yeah.
Cool. Let's see if there are any other questions. No questions, guys. If you're done with the questions, then I'm going to hop straight into our last bit of the derivatives discussion. Give it another second or two. Doesn't look like it. Thank you very much, Ross. Thank you, Vaughan, for highlighting these things for us. Thank you for discussing the details. It's always nice to learn about the companies that we invest in. Sean, thanks for your update on the technicals. I'm going to take over the share now and quickly run you through the last piece of the derivatives. I'm going to start with, let's just make sure that you all can see my screen. Was that a thumbs up, Sean? Yeah, thank you. Right, so we were talking about derivatives. You guys asked about it and said, how can we make use of derivatives to get some more exposure? What are the different uses of derivatives? And we discussed the use of a derivative for the purpose of hedging your portfolio without having to sell and realizing the capital gain. And the second one was speculating. So let's hop straight through it and see if there are anything that I need to highlight. So we spoke about what derivatives were and the margin that you pay, the good faith deposit in order to get exposure in them. We spoke about the use in hedging and the speculative use of it. I reminded you that there was huge risk in derivatives in that the gearing effect comes back and bites you, and I'll show it to you today in the actual numbers. You could go long and you could go short, something that you can't do with a regular equity holdings in South Africa. So you can short the derivative, sell something that you don't have, hoping to buy it back before settlement takes place or before you have to deliver it at the end of the contract expiration, and then buy it back cheaper in order to make a profit. We quickly discussed the differences between an actual equity trade and a CFD trade the last time. And today I want to talk you through this table. It looks like a lot, but I'm going to try and show you my mouse pointer. So what we did here is I took Aspen and I said, okay, let's use an arbitrary share price of 186 bucks. And let's say we wanted exposure in 300 shares. Can you see the highlighted part there, Sean? Okay, perfect. So we start out day one with 300 shares of Aspen. The stock's trading at 186. If you take that 186 and you multiply it by the 300 stocks, it gives you 55,800 rands worth of exposure, right? Obviously, the guys who give you the full exposure charge you interest. I calculated the interest there, and I calculated the brokerage on the deal at 0.4% of the exposure. Added VAT to that, bringing the total cost to 256.68. Margin, or the good faith deposit that you would put down to get this exposure, is only 15%. So that's 8,370 rand you take out of your pocket and put down as a good faith deposit, along with the brokerage in that. And that means your cash flow on the day is minus 8,643, which is here right at the bottom. And that is to give you exposure in 300 Aspen shares. Let's say on day two, the stock price changes from 186 to 184. So it drops 2 rand. Now, if you do simple math, 2 rand times 300 shares is a loss of 600 bucks, which I've indicated at the bottom here. But to that 600 rand, you do get interest on your margin. You pay interest on the exposure, but the margin reduced because the margin's based on the exposure. So your margin reduced by 90 rand, leaving you with a movement of another 526 rand negative in your account. But on day three, the stock runs from 184 to 189, which is a 5 rand gain times 300 shares. That's 1,500 bucks. Less the costs, and the movement in margin gives you 1,200 rand positive move. And on day four, the stock jumps to Ross's base case, which is 192 bucks, giving you exposure of 57,600. You pay brokerage to close out the position again. You get back your margin from the previous day, even though the margin increased on the day. And the cash flow to your account is another 9,000 rand. So on day one, you lost 600. You just use simple math. On day two, you made 1,500. Day three, you made another 900, giving you a total of 1,800, which is the difference between 186, our current share price more or less, and the base case Ross illustrated to us of 192. So 6 rand on 300 shares gives you an 1,800 rand profit. And that 1,800 rand profit came about by employing at the most 8,505 rand. That 1,800 had costs, yes. If you take all the costs off, you end up with a net profit of 1,212. So 1,200 bucks. If you put that on top of 8,500, it roughly gives you a return of 14%, even though the stock only moved 3%. The stock moved from 186 to 192, but you effectively made a gain of 14% because you made 1,200 on your good faith deposit of 8,500. Is that easy to understand? Is that clear? And are there any questions about how this cash movement works on derivatives? I see Virgil says he missed the first 3 parts of the derivatives discussions. It's not a problem, guys. What we're going to do is the last time round, I put up a poll and I asked you if you would attend something at our offices or whether you would prefer to do it online. And I think what we will do is I'm going to send out an invite to next week's discussion, and we're going to be doing it. We're going to try and do it at the normal time, which is 11:30. But then what we're going to do is I'll do a quick discussion in the evening highlighting what was said in the morning and then going into a bit of a discussion. I'll take some questions on the derivatives and so on for those of you who've missed it. So look out for that invite, and then we'll see how it goes in the evening, and then we can put something together and do a whole comprehensive thing around the use of derivatives and gaining more exposure in your portfolio without employing more cash necessarily. I don't see... yeah, Rajesh, yes, you heard correctly. The preferred health stock in our portfolio is Life Healthcare over Adcock and Aspen, definitely. Any further questions? Anything on the derivative side of things? Doesn't look like it. Vaughan, Ross, thank you very much. Oh, hang on. How's the instruction given when to close? Vessel says. Vessel, very easy. When you give an instruction to buy the stock, same thing happens when you buy the derivative. You can enter it online, or we can enter it on your behalf for you to buy. And then when you sell out the position, you just sell the stock again, or you sell the position. We term it differently because on the derivative side, we call the buy going long. We say it's going long. And to cover it, it's just to close the position or sell. But when you go short, selling something that you don't have, then you just end up buying it again. So it's a bit of a mix, but the term to cover it, it happens in exactly the same process. The underlying is bought and sold. The derivative is booked. There's nothing funny to it. It's just getting the terminology right, saying that you're liquidating a position. So if you're giving it in person, so that the person knows what you are doing, which side of the position you're on. Hope that helps. The instruction can be given anytime during open market hours, Vessel, if that is what you're asking about the time. I don't see any further questions. Yeah, I think we can close it, guys. Thank you very much. Thanks for your time, Vaughan. Thanks, Ross. It's been great. James says, what? Wait. Hello, James. It says, what kind of investor should make use of derivatives? CEOs often is seen to enter CFDs. Should smaller investors take the risk? It definitely isn't for everybody, James. As long as you understand the gearing effect of it, I think anybody can make use of it. You can take relatively small positions and you end up paying brokerage of 0.4%. So the small position doesn't attract a minimum fee like it does on the equity side of things. And it doesn't have the same settlement times in that. I mean, it's instantaneous, the cash flows, and you can apply that cash in your derivative account to something else again tomorrow or later that day. So definitely small investors can definitely benefit from this, either by hedging their positions instead of liquidating the stock and paying full brokerage if they're expecting adverse price movements. Alternatively, you can take a small position and increase the amount of exposure that you have in that stock by making use of a derivative. But the crucial part here is you have to be able to afford the initial margin, and you have to be cognizant of the fact that the gearing effect is going to be cash intensive when it moves against you. I explained to you on the table there that we employed 8,500 Rand to make 1,200 Rand. So we made 14% of 3% stock movement. Remember that the gearing is at least 6 times the movement in the stock if you're using 15% as margin.
Maybe just to add as well, Sarel, is that the question related to CEOs. Remember, there's JSE disclosure that if CEOs and prescribed officers sell shares, they have to disclose it. I think often the time the CFDs, they don't have to, so they use this as a way of hedging their positions without having to disclose it to the market.
Thanks for picking that up, Vaughan. I missed that first part of it. Thanks very much for that answer. So yes, not only for CEOs, for everybody, as long as you understand the risk. Very important. If there are no further,
Just for myself, Sarel, have
Yes,
you,
bud.
you've gone through calls, etc., and Vaughan and all that stuff, or are you still doing that?
No, we haven't done anything on options because we don't effectively trade options. But what we will do, Vaughan, is when I do the seminar on derivatives, the evening one where we have a lot more time, we'll certainly deal with warrants, and warrants effectively are put and call options. So I will have to deal with options and expirations and stuff like that, and with volatility. We'll definitely deal with that there. I think explaining options in a forum such as this, there's just too little time.
No, I completely agree. This is a lot more straightforward. Options, there's a lot more moving parts.
Yeah. If there are no further questions, gents, thank you very much for informing us today. Oh, hang on, there it comes, Rajesh. What are actively traded EFT notes? Vaughan, do you want to? I'll take it. It doesn't matter. Rajesh, EFT. I think you're referring to ETFs. So ETFs are exchange traded funds, which typically mimic an index, right? And the ETNs are typically something that mimics a sector or a physical commodity. So it's just an instrument. It trades like a normal stock, but it does have it's almost a derivative in some instances, but the ETF itself is just a mimicking of an index. So if there's 10 Anglos, 2 Aspens, 1 FNB, etc. in the Aussie, and you trade Satrix 40, then Satrix would mimic that exact same thing by putting 2 Anglos, 1 FNB, and 2 Aspens into that index. So those are your EFTs.
Also, just to add one subtle but important difference, an EFT is backed by the exchange, it's like the share, so you won't lose money if the exchange blows up. An ETN, you take on the credit risk of the company that issues it. So if FNB issues it, it's on their credit risk. So if they blow up, you don't get paid. So it's a subtle but very important difference when markets are volatile.
Yeah, thanks for picking that up. Rajesh, I hope that answers. Yeah, Rajesh gives thumbs up, and then I don't see any further questions. So this time around, we are going to close it. Vaughan, Ross, thank you very much. Thanks, guys, for participating. We'll see you next week, and look out for the invite because I'll also stick a time in for Thursday evening, and we'll see if we get any attendance or interest, and I'll hop through the whole derivatives discussion again in that one. Thanks very much for joining us. Have a great day.
Thanks, Sarel.
Yes, bye.